Let me start with your words from the conference call, where you said in relation to this year, you've been a little disappointed in the top line versus what you were hoping to see. And as a result, you've adjusted headcount more aggressively to match a drop in volume. Give our viewers some background there. What were you expecting to see this year and why the headcount reductions are needed?
Yeah, thank you for the question. When we first came into the year, we were anticipating, very modest volume growth. And as we've gone through the year, the first quarter was up maybe 2%. Second quarter, we were down maybe something like 4%. And this quarter, the third quarter, we were down about 8%. So we've seen volume tail off. And to your point, the team has done a very good job at getting ahead of that and not just matching our cost structure to down volume, but creating productivity. I'm very proud of the team for in this environment where volume was off 8%, we improved our operating ratio, which is operating margin, by about 2 full percentage points, which is just really solid progress this quarter.
Specifically to your point, I guess fertilizer and sulfur carloads down 5%. I know ag products showed some weakness, energy as well. What are you seeing now, though, and what are your expectations for what is the remainder of this year?
Yeah, the economy for freight railroads is pretty weak right now. Some of that's specific to railroads and our macroeconomics. So fracking sand is down pretty dramatically. Coal is down pretty dramatically. On the premium side of our business, international intermodal, domestic intermodal, as we compete against a very soft truck market, are both down. There are some bright spots, crude oil, petroleum, LPG. We're seeing some bright spots in food and refrigerated. We see some bright spots in construction and in plastics. But overall, what it feels like to me is that the economy, the industrial economy, is slowing, and it's slowing quite a bit. Now, our volumes are off more than the industrial economy is, and that's specific to railroad economics.
Hey, Lance, your comments are matching right with what Cass Freight told us for September earlier in the week, but they went farther and said that their forecast is that GDP goes negative before the end of the year. Are you going that far?
I won't predict a recession. I certainly hope that doesn't occur. I see some headwinds and some potential shocks, trade being one of them, to the U.S. economy, so we've got to get those decisions right. The good news is I don't see a significant bubble. Clearly we don't have a bubble in the housing market. That remains relatively weak. We don't see it in lending, don't see it in consumer behavior. So the economy has the opportunity to muddle through this and get its feet back under it, but we've got to get trade right.
And when you're talking about trade, Lance, you don't just mean trade with China, but you also mean the United States-Mexico-Canada agreement. That's critical for your business as well.
That's right. The USMCA needs to be ratified. I think it makes all the sense in the world that timing is right now. Trade Representative Lighthizer has done a tremendous job with Congress addressing their concerns with the negotiated agreement. So I think he's made great progress. I think we're at a place now where it's time to take action. That's the right thing to do for the U.S. economy. You know, our biggest trade partners by far on manufactured goods, and that's where the great jobs are in the United States economy, are Canada and Mexico. They support something like 12 to 14 million jobs at average wages better than the rest of the economy. So it's critically important that we get that ratified and move on to a trade agreement with China, ultimately a trade agreement with the European Union as well.